Good day, students. This is CMA Mrudula, and today I'm here with you to continue the marathon revision series that we had started for the subject financial accounting for Inter. Let us carry on quickly to the part 3 of the revision for financial accounting. It's going to be a slightly longer video session today, so let's quickly move on. The chapters that are going to be covered under part 3 are going to be partnership accounts, royalties, hire purchase, branch accounting, and departmental accounting. Now let's begin with partnership accounts. Let us first dilute the entire chapter and understand what are the major aspects in this chapter. There are just three major aspects in this chapter. One being goodwill, second one being profit sharing ratio calculations, and third one being some specific ledger account preparations. Each of these aspects will slightly vary in different scenarios that a partnership firm will come across. The various scenarios that you will find in a partnership firm is first one being admission of a partner, second one death or retirement of a partner, third one insolvency or dissolution of the firm, fourth one amalgamation of firms or conversion of the firm to a company. So let's first take up the first aspect, that is goodwill calculation. Goodwill calculation as such will remain the same whatever the scenario firm is coming across. So let us see the steps that is required for calculation of goodwill. There are three methods of calculation of goodwill: average profits method, super profit method, and capitalization method. Let's take a look at average profits method. So under average profits method, first you derive at the average profits of the specified period mentioned in the question. The question will mention the period, say 3 years or 5 years, and will also provide with you the profit figures for those 3 or 5 years. Subtract any casual income if mentioned, add any abnormal loss if mentioned, add capital expenditures if mentioned, then subtract a provision for taxation. You will arrive at average maintainable profits. Now, average maintainable profits into the number of years of purchase will give you the goodwill amount. So, number of years of purchase will also be mentioned in the question. Moving on to the next method, super profit method. Under super profit method, we first arrive at something called future maintainable profits, FMP. For that, again, derive at the average profits or the weighted average profits. Similar fashion, the profit figures for the period mentioned in the question, say the profits for 3 to 5 years will be mentioned. You have to calculate the average of those profits for those 3 to 5 years. Average profits minus casual income, add abnormal loss if any, add capital expenditures if any, subtract the provision for tax, you will arrive at FMP. The term just differs because the method is different. And then we arrive at average capital employed. What would that be? First, assets you have to understand. So assets minus liability is capital employed. So what is assets? Assets means total of assets minus fictitious assets minus non-trading investments and goodwill. All of that you remove from the total value of assets and arrive at the asset figure required for calculation of average capital employed. What does liability mean in this formula? Total of liability minus the capital minus dividend minus long-term liabilities. Okay. After arriving at these two assets and liability figure, you have to subtract liabilities from the assets. You will arrive at average capital employed figure. Then calculate normal profit. What is normal profit? Average capital employed into normal rate of return. Again, this will be mentioned in the question. After arriving at normal profit, arrive at super profit, which is future maintainable profits, FMP, minus the normal profit that is calculated above. That is super profit. Using super profit figure, we will calculate goodwill. Goodwill is equal to super profit into number of years of purchase. The information of which will be mentioned in the question. There's another formula using the same information of super profit, which is goodwill is equal to super profit divided by normal rate of return into 100. We'll arrive at the goodwill figure. next method, which is capitalization method. Again, we calculate adjusted maintainable profits. Same thing, average profits minus casual income plus abnormal loss plus capital expenditure minus provision for tax. That remains the same. Then calculate normal capital employed, which is AMP, adjusted maintainable profits, divided by the normal rate of return into 100. You will arrive at normal capital employed. Now, what is actual capital employed? Assets minus liability. Okay, so assets, as we have already seen, assets and liability figure that is used for goodwill calculation, if any, is going to remain the same. Using these two figures, we arrive at goodwill. Goodwill is equal to normal capital employed minus the actual capital employed. The next aspect being profit sharing ratio, that is PSR calculation. PSR calculation would vary depending on the scenario, so we shall take that up as we cover the various scenarios. The third aspect is ledger accounts preparation. So there are two unique ledger accounts that we have to prepare in partnership chapter. The first one being revaluation account. So when there is a change in composition of the firm, which could be admission of partner, death or retirement, or any such other change in the composition, the assets and liabilities of the firm are revalued. Okay, so we have to bring in all the assets and liabilities. So we have to account for any such increases or decreases in assets and liabilities. If asset is decreasing, then you have to debit the revaluation account. Asset is increasing, then credit the revaluation account, because the journal entry would be asset account to revaluation account. If the liability is decreasing, credit the revaluation account. Liability is increasing, debit the revaluation account, because the journal entry in this case would be revaluation account to liability. When liability is increasing, liability will be credited because liability has a credit balance. Okay, here the term liabilities does not include goodwill and reserves and surplus. After passing such entries into the revaluation account, the profits and losses due to revaluation is transferred to the partner's capital account in their profit sharing ratio. If profit sharing ratio is not mentioned, then use capital ratio. Now, these are the steps to be followed if the balance sheet values are also to be changed. Now, when balance sheet values should not be changed even post revaluation, then you're supposed to open memorandum revaluation account, pass the entries as discussed above, share the profit and loss to the partners in the old profit sharing ratio, then reverse all the entries and again calculate the resultant profit and loss, transfer this profit and loss in new profit sharing ratio to all the partners, including new partners if there is an admission. So this is just an adjustment between the profit and losses, old profit and loss and new profit and loss, and arising due to the profit sharing ratio changing. But ultimately, the values of assets and liabilities will not undergo any change. So the question will mention if the balance sheet values should not be changed. In such a case, you have to follow this method. This is rare. The next ledger account to be prepared in partnership firms is partners capital account. Ledger balance will look like this. The credit side will have all those entries that will increase the capital amount. There's a balance brought down, profits, reserves, goodwill that is distributed, and amounts contributed by the partners. The debit side will have those figures that will reduce the capital balance amount, that is loss and amounts paid to the partners already. Debit balance in a partner's capital account will reflect the firm's liability towards the partners. Credit balance in partner's capital account will reflect the partner's liability to the firm. Now let us look into the various scenarios and how that could change the composition of the firm. The first one being admission of a partner. On admission of a partner, let's first take up the PSR calculation aspect. So when a new partner is being admitted, the profit sharing ratio would definitely undergo a change because the ratio of the new partner also should be added. So there are certain steps to calculate the profit sharing ratio of all the partners, including the new partner. Now, if the question has provided with the new partner's share, then the steps are: first, calculate the balance share available, that is 1 minus the new partner's share, which could be 3 by 5. So 1 minus 3 by 5. Then divide this balance share to the existing partners using their old profit sharing ratio. Okay, so now 1 minus 3 by 5 is 2 by 5. So divide 2 by 5 to the old existing partners in their old PSR. If the old PSR was 1 is to 2 is to 1, divide 2 by 5 into 1 is to 2 is to 1 to arrive at the shares of the three existing partners. Sometimes a division ratio for this also would be mentioned in the question. If so, please follow that instead of the old profit sharing ratio. Now, after arriving at the shares of the existing partners, we also have the share of the new partner. The example that we are discussing now, the new partner's share is 3 by 5. Balance being 2 by 5 is divided to the existing partners in their old PSR, which is 1 is to 2 is to 1. So on dividing 2 by 5 to the existing partners in that ratio, we arrive at their shares, which is 1 by 10, 1 by 5 and 1 by 10. Now, as you can see, all the shares have different denominators. So we cannot arrive at one ratio if the denominators are different. Okay, so we have 1 by 10, 1 by 5, 1 by 10 and 3 by 5. So we have to bring everything to a common denominator. So always convert the denominator into a higher value. So we convert the 5s into 10. So 1 by 10 remains the same. 1 by 5 becomes 2 by 10. Then 1 by 10 remains the same. 3 by 5 becomes 6 by 10, because we are multiplying 3 and 5 both into 2 to arrive at a denominator of 10. So now the ratio is 1 is to 2 is to 1 is to 6. So this is the new ratio against the old one, which was 1 is to 2 is to 1. So to revise the steps, in case a sacrifice ratio is given and the new partner share is given, use the sacrifice ratio to calculate the new shares of the existing partners. Arrive at the balance share using these new shares of the existing partners. Using the balance share, calculate the new partner's share. Okay, with the information given in the question. And now that we have all the shares of all the partners, bring them all to a common denominator to arrive at the new profit sharing ratio. Moving on to the next aspect, which is goodwill. So in case of admission, premium of goodwill will be introduced by the incoming partner. Now that premium of goodwill which is being introduced by the incoming partner is distributed to the old partners in sacrifice ratio. Okay. So the entry in such a case would be cash account. This is the premium of goodwill introduced by the incoming partner to the old partner's account A, B, C in sacrifice ratio. So far, we have seen a case where the existing partners are sacrificing a part of their profit sharing ratio. There could be a case where partners are gaining as well. Now, in such a case, the new partner, along with the existing partners who are gaining, may come up to introduce premium of goodwill. In such a case, the gaining partners will bring in the goodwill along with the new incoming partner, and the other partners, the sacrificing partner, will share the goodwill in their sacrifice ratio. So information with regard to introduction of premium of goodwill will also be given in the question. If the premium of goodwill will be introduced only by the new partner or by gaining partners as well, will be mentioned in the question. The next aspect to be covered in this scenario is ledger account preparation. So as discussed already, revaluation account is to be prepared. In most of the cases that would be necessary, and then partner's capital account would have to be prepared to arrive at the balance of capital accounts of all the partners. One important point that you have to remember in case of admission of a partner is that you're supposed to distribute reserves and surplus and profit and loss debit balances as well to all the partners and existing partners in their old PSR. If the partners decide to maintain the same assets and liabilities post admission, then again bring back the reserves and surplus amount by debiting the capital accounts of all the partners, including the admitted partner in the new PSR. The next scenario in a partnership firm is death or retirement of a partner. So previously we saw a partner coming in, now we are going to see a partner going out. In case of death or retirement, the first aspect being profit sharing ratio, PSR calculation. But here PSR calculation is not given much importance. Goodwill would have to be recalculated in case of death or retirement according to the steps already discussed. After calculation of goodwill, it has to be compared with the goodwill already present in the balance sheet. Any overvaluation of goodwill in the balance sheet, that has to be written down, okay, to the remaining partners in the old profit sharing ratio. The entry would be remaining partners account to goodwill account. Okay. In certain cases, if the question mentions you're supposed to write off the entire goodwill amount. Undervaluation of goodwill in the balance sheet are very, very rare scenarios which would not generally arise. So it would either be overvaluation and write down or write off the goodwill completely. The next aspect would be ledger account preparations. Case of retirement of partner, prepare a revaluation account. All the assets and liabilities have to be brought in and transfer the profit and losses to the partners. Transfer reserves and surplus, the debit balance and profit and loss account in the balance sheet to the retiring partner as well. Okay, the retirement is retiring partner alone. Okay, if the retirement is not in the year end, then the profit and loss calculated so far should be accounted through the profit and loss suspense account. Okay, for the year, the trading profit and loss, and also settle the retiring partner salary, commission, interest on capital, and adjustment in drawing, if any. In case of death of a partner, partner's executor's account has to be opened, and in the similar fashion, revaluation, profit and losses, undistributed profits, current year profits to the date of death, joint life policy, claim amount, and his share of goodwill has to be distributed to him. Settle the salary, commission, interest on capital, and adjustments in drawing, if any. Now, the amounts could be settled as a lump sum amount if the firm has enough funds, or it shall be treated as a loan and settled in installments along with interest rate decided upon. So, the difference between admission and retirement or death in case of ledger accounts is that in case of retirement or death, the reserves and surplus and debit balance of profit and loss account is distributed only to the retiring or the deceased partner account. Goodwill is recalculated and compared with the existing goodwill to write down any overvaluation or write off the goodwill fully. Let's move on to the next scenario, which is insolvency or dissolution of the firm. Insolvency means bankruptcy, which means the firm is unable to pay off its debts. In certain scenario, one or all the partners may also become bankrupt, which is insolvent. In such cases where the firm has become insolvent, the partners may decide to dissolve, that is, shut down the firm and cease all its operations. So let us see aspect by aspect the adjustments that is required to be done in case of insolvency and dissolution of a firm. With regard to PSR calculation, there is nothing required since the firm is getting dissolved. There is no specific goodwill adjustment as well. Ledger accounts is the important aspect in case of dissolution, and this topic of dissolution is important because of the amount of adjustments that is involved in ledger account preparation. The first ledger account to be prepared is realization account. All the assets and liabilities have to be brought in into this account. Assets have to be sold, liabilities have to be settled. Now, in case where all the partners are insolvent, liabilities are not brought into this account, a separate account is prepared for settling the liabilities. So all the assets and liabilities, that is including reserves and surplus, debit balance of profit and loss account, everything is brought into realization account, subject to this one condition that we discussed. Distribute the profit and loss on realization to the partners. The deficiency of the insolvent partner is to be borne by the solvent partners, which means any amount due by the insolvent partner to the firm have to be borne by the solvent partners. Generally, capital ratio is nothing but the capital ratio calculated according to the capital balance brought down. If all the partners are insolvent, a deficiency account is opened. All the liabilities are transferred to this account, and even the partners' balances are brought into this account. The liabilities of the firm is set off with the partners' balance amounts. Now, those partners' balance amounts reflect the amounts that the partners owe to the firm. So the amounts owed by the partners to the firm and the amounts owed by the firm to the creditors are set off with each other. The partners may also have an understanding with the creditors and write off the dues to the creditors with the dues by partners to the firm. All partners being insolvent and opening a deficiency account are only in rare scenarios. Generally, the amount that is realized from sale of assets in this realization account is used to settle off all the debts and dues. But there is a specific order to be followed in case of settlement of dues during dissolution of the firm. First of all, the realization expenses are to be paid off. This realization expenses are paid off by bringing in the expenses in the realization account itself. And then preferential creditors are being paid off. Then secured creditors are being paid off. Secured creditors uh, are namely secured loans from banks. Then unsecured creditors are paid off. Unsecured creditors are all those other sundry creditors of the firm. And then the partner's loan is being settled. That is the loan given by the partner to the firm. And then the partner's capital is being paid off. This is the order to be followed in case of realization of dues by the firm. This has to be kept in mind while preparation of realization account, cash account, and deficiency account if prepared. Now, when we come to partners loan and partners capital settlement as well, for determination of the order of settlement of partners, the Act has prescribed two different methods. That is, first one being surplus capital, also known as proportionate capital, also known as highest relative capital method, HRCM. The second one being maximum possible loss method. So let us understand each method. The first one being HRCM, highest relative capital method. Under this method, a table as such is prepared. We could have more rows for each partner separately as well to make the calculations easier. Okay. Here, since I am presenting without any figures, only the particulars portion is being displayed. So, with regard to the calculation, first the capital balances are to be brought down. Add in the reserves and surplus balances to be distributed to the partners. That will be the adjusted capital. Divide the adjusted capital by the PSR, the profit sharing ratio. We'll arrive at different capital amounts. Now, among all the capital amounts of the partners, choose the lowest capital amount as the base capital. Okay. Multiply the base capital into each partner's profit sharing ratio. Okay. You will arrive at the proportionate capital of each partner. Subtract that with the adjusted capital of each partner calculated here. We will arrive at the surplus capital. Now, these steps are repeated till we arrive at the surplus amount for one partner. Now, how will it go forward from the second repetition? The second repetition onwards, the surplus capital will become the adjusted capital. So, we'll start from here for the second repetition. So, this will be the adjusted capital divided by the PSR of each partner. You will arrive at different figures. Choose the lowest to be the base capital. Multiply that base capital amount into the PSR of each partner to arrive at each partner's proportionate capital amount. That minus the adjusted capital of the second repetition will arrive at the surplus capital. So generally, only two such repetitions would be required and we would arrive at surplus capital for one partner. How would the order of payment be? The partner with that surplus capital is paid first, an amount equal to the surplus capital amount is being paid. Then an amount equal to the total of the next two partners' last proportionate capital is paid off. The amount is divided in their PSR. Okay, that is the last repetition proportionate capital amounts are being totaled. That amount is being paid off to those two partners in their PSR. Okay, then the balance amount is paid off to all three partners in the PSR. Repeat the order of payment. First, the partner having the surplus capital is being paid off. What is the amount paid? Amount equal to that surplus capital. Then next, the other two partners are being paid off in PSR. But what is the amount paid? Amount equal to the total of their last proportionate capital figure. Then the balance amount is paid off to all the three partners in profit sharing ratio. The second repetition would arise generally when there are three partners. When there are only two partners, you would arrive at the surplus capital mostly within one series of steps itself. Let's move on to the next method. Let's move on to the next method, maximum possible loss method. Again, a table as we prepared with this information. We could have more rows for each partner. This reflects only the particular row. You could have rows for each partner and a total row as well. So, first of all, take the total capital balances of all the partners put together minus the cash balance that is available for distribution for the partners. After distributing the other dues as mentioned here, the balance is being paid off to the partner. That cash balance is arrived at and subtracted from the total capital balance to be paid off to the partner. That is the total maximum loss. That means the total capital minus the cash that is paid off. If you arrive at a balance, that is the balance that the firm will be unable to pay. That is the maximum loss that uh, has to be borne by all the partners put together. Multiply this into the PSR of each partner to arrive at the maximum loss of each partner individually. Subtract the capital balance of each partner as we have in the first case individually. Now, after reducing the individual maximum loss from the capital balance, we may arrive at either a deficiency amount or a surplus amount for each partner. Deficiency means the loss is higher than the capital balance, which means that partner will not be paid any amount at all. Surplus means the capital is higher than the loss amount, which means that even after adjusting the loss that the partner has to bear, he will be paid off some capital balance. Now, in case of those having a deficiency, the deficiency amount is distributed to the partners having surplus in their profit sharing ratio. After distributing the deficiency amount to the partners having a surplus amount, subtract the surplus from the deficiency amount and then you would arrive at an additional surplus amount. So the partner having the additional surplus amount is being paid off from the cash that is available. The other partners would not be paid off any balance at all. So the steps are repeated depending on the number of installments of settlement of assets. If the cash that is becoming available to the firm is uh, on installment basis, then for each installment a separate such number of steps have to be repeated. Okay. The balance capital of the other partners is unpaid as we have discussed already. And the last scenario that a firm would come across, which is amalgamation of firms and conversion of firm to a company. From the time Syllabus 2016 exams have been conducted, that is from June 2017, almost 6 exams so far, these topics have not been asked at all in section B. Only admission, death and dissolution have been covered since they are important topics in partnership accounting. So let us just cover some major aspects in amalgamation and conversion. So not to skip this topic altogether, but to just have an idea. If we get some theory-based questions in section A, you would be able to answer them. Now, what does amalgamation mean? Two firms are coming together to become one firm. Okay, that is, two firms are amalgamating to become one firm. In such cases, we have to open a realization account of the firms that is getting shut down. Similar fashion, transfer all the assets and liabilities, settle the liabilities, sell the assets. All unrecorded items are also to be brought into the realization account, reserves and surplus and debit balance of profit and loss account as well. Then purchase consideration is to be calculated. Purchase consideration is the amount at which the new firm will buy the old firms which are getting amalgamated. Purchase consideration is nothing but the total assets minus the total liabilities of the firm getting amalgamated. This amount is taken on the credit side of the realization account. New firm account will be debited. Then, as usual, the profit and loss on realization is transferred to the partner's capital accounts. Then we have to account for the receipt of the purchase consideration from the new firm in the form of capital and new firm account. So, the ledger account of new firm account has to be opened to bring in the purchase consideration due and the receipt from the new firm. Close all the accounts by transferring the balances to the capital accounts and settle the partners. In the new firm, what has to be done additionally, apart from bringing in all the assets and liabilities, is that if the purchase consideration is more than the assets and liabilities, a goodwill has to be created and taken on the asset side. If the purchase consideration is less than the assets and liabilities, capital reserve has to be created and shown on the balance sheet on the liability side. So here the assets and liabilities of the firm getting amalgamated is being compared with. Okay, to avoid your confusion, purchase consideration of the firm getting amalgamated, a single firm. First, compare for each firm separately. So purchase consideration of that firm if is more than the assets minus liability of that firm, then it is a goodwill. That means that firm is being amalgamated at a higher value, at a goodwill, which has to be shown in the new firm on the asset side. If the purchase consideration that is paid for that amalgamated firm is less than its assets and liabilities, then it is taken at a lower value and a capital reserve is being shown on the liability side of the new firm. The second scenario is conversion of the firm into a company. That is, a company is taking over the firm. The steps would remain same as amalgamation. Bring in all the liabilities into realization account, calculate the purchase consideration and take that as well in the realization account, divide the profit and loss and realization to the partners, open new firm account and settle that with a receipt of purchase consideration, close all the balances to settle the partners. One additional point you have to take note of in case of conversion to a company is the purchase consideration need not necessarily be paid only in cash. It could be paid even in the form of shares, debentures, or a combination of any. So here we come to an end of the chapter partnership. We've made it as concise as possible and brought the whole chapter into 3 points and 4 scenarios. Now let's move on to the next chapter, royalties. Let's first understand about the term royalties. Now, who earns royalty? First of all, an owner of an asset. Now, what does that asset cover? It could be a copyright, a patent of an invention, a content for a novel, or a content for an educational book. Okay, so owner of any of these will earn royalty. So which means the owner would ideally be the one who has created any one of these. So such a person will earn royalty. Okay. When does the owner receive royalty? When the owner gives the right to use this asset to a third party. So on what basis is royalty earned? Generally the basis will be units sold. Apart from that, a minimum rent amount is assured and guaranteed to the owner in case the revenue from sales does not reach the agreed minimum baseline or there is no revenue. What is to be learned from this chapter is mainly accounting for royalties in the books of the lessee and the lessor. Calculations are limited to calculations of short workings. Now, let us first look at the basic calculations that is present in the chapter royalties. So, first of all, royalty is what? Royalty, actual royalty is equal to royalty per unit as agreed upon into the units sold. And there's an agreed minimum rent amount also mentioned in the agreement. Now, if the actual royalty is more than minimum rent, then the actual royalty is paid to the owner. Let us take this scenario where there is no short workings carry forward, because as of now we have not touched upon short workings. So if there is no short workings carry forward, pay the actual royalty. Now, if actual royalty is less than the minimum rent amount is paid to the owner. Parallelly, short workings amount is calculated. That is, short workings is nothing but the minimum rent paid minus the actual royalty. So short workings means the amount paid higher than the actual royalty that is earned due to the sale. Now, this exercise is done on a yearly basis. Now we have a carry forward of short workings. What we will pay is the actual royalty calculated minus the short workings carry forward. So we're adjusting the higher amount paid in the earlier years. Okay. One thing we have to keep in mind is that short workings has a recoupment period. Okay. So it could be a fixed period or a flexible period. The question will mention the same. So ensure before using the carry forward short workings that the period of recoupment exists. If it is expired, then you cannot adjust the short workings with the actual royalty. So the calculation is simple. Okay. Royalties is relatively a small chapter. Importance level is not high compared to the other chapters. So on quickly wrapping up the royalties chapter, let's move on to the next chapter, hire purchase. Hire purchase basically means lease agreements. Generally, companies take high value assets on lease. Purchasing high value assets and machineries would involve a lot of investment or would require a loan system. Instead of doing the same, the companies would take them on lease, which would have much lesser interest to be paid on the installments, and also provide the company some amount of flexibilities. Those companies providing these assets on lease to manufacturing companies are called non-banking financial corporations, that is NBFCs. Here, though the lessor is the actual owner of the asset will still be shown in the books of the lessee. This is a perfect example of where the legality of the transaction is ignored and the performance of the transaction is considered for accounting. There are two things that we need to know under this chapter. One being calculation of installments and second one is accounting. Let us first look into the accounting aspect. There are two methods of accounting, one being cash price method and the second one is called interest suspense method. So under the cash price method, in the books of the hire purchaser, that is the lessee, supposed to open asset account, hire vendor account, which is a liability account, depreciation account because the asset is shown in the books of the lessee, and interest account. Hire vendor account will show the full amount of installments due to the hire vendor. As and when the payments are being made, the interest account is also debited while the payment is being made. In case of interest suspense method, in addition to these four ledgers, interest suspense account is also created. In this method, on the first year itself, while the asset account is debited and the hire vendor account is credited with the entire installment amount, even the interest suspense account is also debited with the entire interest amount. As and when the interest becomes due, interest account is debited and interest suspense account is credited. Payment is entry is passed by just debiting the hire vendor account and crediting the bank or cash account. Generally, at the end of the lease period, on payment of the last installment, the asset can be bought by the hire purchaser. Let us look into the calculation of installments. Two scenarios. The first scenario is where you have to calculate the cash price with other information like installments and interest and down payment being available. So the formula will be the third installment minus the interest plus second installment minus the interest plus first installment minus the interest adding the down payment. This will give the total of the cash price of the asset. Another formula for calculating the cash price is number of installments into the last and final installment minus difference between any two installments, which is basically the last install interest amount. So this second formula is followed when the interest amount is not provided in the question. Another scenario where you have to calculate the installments and interest and cash price is given. So a table as such will have to be drawn up. It should contain all these details: the date, opening balance, payment made towards principal, interest, installment, and closing balance.
The first entry will be on the date of possession, that is day one. The opening balance will be the total cash price. The payment made towards the principal will be the down payment made on the date of possession. There will be no interest on day one, no installment payment being made. Closing balance will be B minus C, opening balance minus the payment made towards the principal. To give you a perspective of the cash price is the actual cost of the asset, which is also equal to the sum of all the installments minus the interest portion. Okay, principal here means payment made towards this cash price. Interest will be made in this table on the due dates of the installments. So the installments could fall due either fortnightly basis, on a monthly basis, quarterly basis, semi-annually basis, or yearly basis. So on the basis of the information given in the question, entries have to be done in this table. From the second entry onwards, the opening balance, that is the amount due on that date, will be the closing balance brought down. We'll have to calculate the payment made towards the cash price because we have installment amount with us. So we take column E, installment amount, as given in the question. Interest has to be calculated based on the rate of interest given in the question. Interest will be opening balance on that date, B into the rate of interest. So now the payment made towards the principal or payment made towards the cash price is E minus D, installment minus the interest portion. And then finally the closing balance is B minus C, opening balance minus payment being made.
So, with these two topics being covered, accounting and calculation of installments, and covering two different methods in each of the topic, we shall move on to the next chapter, branch and departmental accounting. Let us start with branch accounting first. So, branches, as we commonly understand, it is created due to geographical requirements. When a company has a lot of branches, the head office may decide to make them centralized or decentralized. If the branches are centralized, the management and the accounting of the branches are done by the head office itself. This is done so to have better control on the branches. So when centralized system is followed, the branches are called dependent branches. Also, this is generally done when the number of branches and the volume of transaction in the branches is comparatively lesser. Now, in case of dependent branches, the accounting method followed by the head office could be any of the three as listed in this slide. It could either be the final accounts method, or follow a debtors method, or follow a stock and debtors method. So under final accounts method, the head office simply opens a branch trading and profit and loss account. Okay, so in at period end, a branch trading and profit and loss account is separately prepared to account for all the transactions that is undertaken by the branch, which would generally be only which would generally be trading transactions. On drawing up a trading profit and loss account, the head office would arrive at a branch profit and loss, which would then be transferred to the general profit and loss account to calculate the company's overall profit or loss. One header that students should remember is if goods are given an invoice price, then remove the loading to ascertain its correct profits. There could be transfers between branches. Second method is debtors method. Under debtors method, the head office opens another account called branch account. So in branch account, all the assets opening balances are being debited, liabilities opening balances are being credited, assets closing balances are being credited, liabilities closing balances are being debited, goods sent from the head office and other branches to this branch is being debited, cash and expenses from the head office spent or sent to the branch is being debited, any goods or cash sent from the branch out is being credited. After accounting for all these transactions, the balancing figure is the profit or loss made by the branch. This profit or loss is then sent to the general profit and loss account. To arrive at these opening and closing balances of assets and liabilities, some memorandum ledger accounts may be required to be prepared. So, under final accounts method, a branch trading profit and loss account is prepared to arrive at the branch profit and loss. Under data's method, branch account is opened to arrive at the branch profit and loss. What is the difference between the two systems? Under data's method, branch owns assets and liabilities. But in final accounts method, the branch does not own any assets or liabilities. The third and the final method is stock and debtors method. Under this method, the head office opens all under this method, head office opens various branch accounts: branch stock account, branch debtors account, branch adjustment account, goods sent to the branch account, branch cash account, branch bank account, branch fixed asset account to uh, record all the transactions that are undertaken by the branch. Final branch profit or loss is calculated in branch adjustment account. Here, all the loading from the stock and goods sent to branch are taken and sent to this adjustment account. This helps to identify the gross profit or loss of the branch. This branch profit or loss is taken to the general profit and loss account. The methods of accounting discussed above were with regard to dependent branches, but head office may decide to decentralize and make the branches independent. In such case, the branches will maintain their own books of accounts and transfer the profit and loss by calculate and transfer the period ends profit and loss of the branch to the head office. Additionally, the branches will have to open a head office account to to record the transactions between the branches and the head office. Any transactions between branches are also considered to be transactions between the branch and the head office itself. Now let's move on to departmental accounting. Now, departments in a company refers to various technical and non-technical departments for operations, say HR, accounts, finance, costing, IT, etc. Every department would require a set of resources for its operations. Big corporates and MNCs would want to value each department's performance. So every department is considered as an activity center. The accounts for every department is maintained separately in a centralized manner and to record the transactions of each department separately. Departmental trading and profit and loss account is also maintained. Now, for this purpose, it is essential to identify each department's expenses and income. Specific expenses and income are already available, which are accounted as such. Common expenses will have to be allocated. The basis of allocation is as such. It, it, it just follows some amount of common sense. Rent is allocated on the basis of floor area occupied by every department, lighting expenses on the basis of number of light points, canteen subsidy on the basis of number of workers, administrative expenses on the basis of mostly equally to all the departments, selling and distribution on the basis of sales ratio, discount received and carriage inwards on the basis of purchases ratio, salary and number of employees, and depreciation on the value of assets. After doing all of this, we can arrive at the exact departmental trading and exact departmental profit and loss. One important point that students must understand under this chapter is term called stock reserve. Goods are transferred between departments, and when goods are being transferred from one department to other, also they are transferred for profits. Now, the point of transferring goods from one department to the other is for them to be sold to the ultimate customer. and profits to be realized for the company as a whole. But even at the year end, when these goods are not sold, they lie in the department's closing stock with unrealized profits. Now, these unrealized profits of the transferring department lying in the closing stock should be removed so as to arrive at the correct overall profits during the year end. So, therefore, after preparation of trading and profit and loss account, stock reserve is removed, and then a general profit and loss appropriation account is prepared to distribute the correct profits to the partners and then transfer the balance profits to the balance sheet. That is, after preparation of trading profit and loss account, the departmental profits are brought down. After totaling them up in the general profit and loss appropriation account, remove the stock reserve overall from opening stock and closing stock is the total value, and after removing the same, the amount is being distributed to the partners and balance is being transferred to the balance sheet. So here we come to an end of revision part 3 for the subject financial accounting. So in this video, in this part we have covered some major chapters like partnership and branch and departmental. Uh, I've tried to make partnership as concise as possible to make the nightmare of partnership that students have a lot lighter. Please do share in the comment box below what you think of this chapter, because as students, even we have faced a lot of hatred towards this chapter.
Here we come to an end of the third part of the revision for financial accounting for Inter. Uh, Effectively a month more left for exams to begin. So I hope your preparation levels have increased, and I hope you've begun with revision and mock exams for preparation right now. So please let me know in the comment box below and like the video if you find it useful. Please share it to your friends. Also, if you want the revision material for financial accounting, please do let me know in the comment section, or you can also mail me in the mail address mentioned in the description, or you can also send me a message on Hangouts by connecting with me in the same email address. All the best, students, and please take care.